A fund with $26 billion tells investors you can't take your money out right now. And most people hear that and think, okay, that sounds like a rich people problem. But here's the part nobody wants to say out loud. When rich people can't get their money out, that's usually when normal people start losing theirs. Because this isn't just about some fund. This is about how money actually moves through the economy and what happens when that flow starts to break. My name is Ari, and I spend way too much time thinking about money, especially the kind of problems that don't look dangerous until they are. And what just happened here? This isn't random. This isn't isolated. This is what happens when an entire system is built on one assumption, that the money will keep flowing. Because once that assumption cracks, everything built on top of it starts to wobble. Most people understand banks. You deposit money. They lend it out. You can take your money back. Simple. But what most people don't realize is that a massive part of modern lending doesn't happen through banks anymore. It happens in something called private credit. And the easiest way to understand this is it's lending without the safety rails. No public markets, no transparency, no easy exit. Just deals behind closed doors at scale. And for a long time, it looked genius because businesses still needed money. Banks got stricter. Regulations tightened. So private lenders stepped in and said, we'll take the risk. And investors loved it. Because instead of earning 2 to 3%, now they're seeing 8%, 10%, sometimes even more. And this is where the first illusion starts. Because those returns don't come from nowhere. They come from risk. Real risk. The kind that doesn't show up until it does. The addiction to better returns. Let's make this painfully simple. You have money. You can put it somewhere safe and earn 4 to 5%. Or you can put it somewhere riskier and earn 9%. Most people don't think twice. They go, well, obviously, I'll take 9%. This sounds normal until you actually think about why that extra 4% exists. It exists because something on the other side of that deal is fragile. Maybe it's a company already loaded with debt. Maybe it's a business barely staying profitable. Maybe it's a structure built on more borrowing. And here's where it gets uncomfortable. A lot of this system isn't just lending to businesses. It's lending to other financial players who are also using debt to buy companies that take on more debt to pay back earlier debt. That's not a small mistake. That's a lifestyle trap at an economic level. Debt on top of debt on top of debt. And as long as money keeps flowing in, it works. Actually, more than works. It looks amazing because new money hides old problems. This is where it starts to break. At some point, you run out of good opportunities. There are only so many strong businesses to lend to, but the money keeps coming in. Investors still want those returns. So what happens? Standards drop. Quietly. Gradually, loans go to weaker companies, terms get stretched, risk gets ignored, because everything still looks fine on paper. And then something changes. Interest rates go up, and this is where the math gets brutal. A business that was paying $4 million a year in interest is now paying $8 million. Same loan, same company, completely different pressure. And suddenly, that solid business doesn't look so solid anymore. Margins disappear, layoffs start, cuts happen, and eventually, some of them just break. The realization most people miss. Here's the moment most people don't see coming. When investors start getting nervous, they don't slowly exit. They rush. They all try to leave at the same time. And that's exactly what these funds aren't built for. Because the money isn't sitting there in cash. It's locked in loans, in deals, in companies that can't just pay it back instantly. So when people ask for their money, the fund has to say, wait, or worse, no. And this is where it starts to feel familiar. Because that's not investing behavior anymore. That's a bank run, without calling it a bank run. Why this actually hits regular people. Now you might be thinking, okay, but I'm not invested in private credit. Maybe not directly, but here's how this leaks into your life. The companies being funded by this system, they're everywhere. Retail chains, healthcare providers, logistics companies, mid-sized employers. These aren't abstract businesses. These are the places people work, the services people use, the companies that keep local economies running. And if their financing dries up, they don't just adjust, they cut. Jobs disappear, expansion stops, and it creates a feedback loop. Less income leads to less spending, leads to weaker businesses, leads to more defaults, and suddenly, this isn't a finance story anymore. It's an economic one, the illusion of stability. For years, this whole system felt stable because it hadn't been tested. Low interest rates made everything easier. Cheap money hides bad decisions. It smooths over weak business models. It delays consequences. But once rates rise, reality comes back fast. And here's the second realization moment. A system that only works when conditions are perfect doesn't actually work. It just hasn't failed yet. The too big to notice problem. Here's the part that should make you pause. This market is now in the trillions, not billions, trillions. And yet, most people have never even heard of it. That's dangerous. Because the last time something this big flew under the radar, it didn't end quietly. And I'm not saying this is exactly the same, but the pattern, it's uncomfortably familiar. Fast growth, complex structures, hidden risk, dependence on constant inflows. That combination doesn't unwind gently. What people tell themselves. At this point, there are two types of thinking. The optimistic version, this is contained. It's just one fund. Markets will adjust. And the other version, this is the early signal. Because problems like this don't usually start loud. They start small. One fund gates withdrawals. Another reports higher defaults. Another quietly struggles. And by the time it's obvious, it's already spread. Conclusion. So what does all of this actually mean for you? It means understanding something simple, but uncomfortable. A lot of the modern financial system is built on confidence, not guarantees. Confidence that loans will be repaid. Confidence that businesses will survive. Confidence that money can always move when needed. And when that confidence cracks, things that felt solid start to feel very different. This doesn't mean panic, but it does mean awareness. Because the biggest financial risks in your life are rarely the obvious ones. They're the ones hiding in systems that everyone assumes are fine, until they aren't. And if there's one thing worth remembering here, it's this. The moment money gets hard to access, that's when you find out what was actually real and what was just working for now.